By the end of this video, you'll know exactly how to turn a single property into a portfolio that generates passive income for decades. And here's the thing. Most people think you need a massive down payment or rich parents to get started. You don't. In fact, I'm going to show you 3 specific strategies that real investors use to build wealth starting from zero. And the third one, nobody talks about it, but it's the reason some investors own 50 units while others are still saving for their first deal. So grab a drink, get comfortable, and let's break it down. The first thing you need to understand is that every portfolio starts with one property. One, that's not just motivational speak, it's the actual math. And the easiest way to get that first property is something called house hacking. Here's how it works. You buy a multi-unit building, a duplex, a triplex, even a fourplex, and you live in one unit while renting out the others. Your tenants essentially pay your mortgage. Sound too simple? Here's the proof. My friend Marcus, he's a nurse in Phoenix, started with a duplex in 2019. He put down just 3.5% using an FHA loan. That's one of the lowest down payments available for owner-occupied properties. The monthly rent from his upstairs neighbor covered $400 of his mortgage. $400. That meant his housing costs dropped from $1,400 a month to about $1,000. He lived in that duplex for 2 years, built up his credit, saved more cash, and then used that property as a springboard for his next one. Marcus now owns 4 units. He started with less than $15,000. Yeah, I know. It sounds like one of those success stories that skips over all the hard parts, but the numbers are real. And here's what most people miss. When you live in the property, you qualify for owner-occupied loan programs that investors can't touch. Lower down payments, lower interest rates. That advantage disappears once you move out. Now, house hacking is the easy win. It's accessible, it works, and you can start with a conventional loan if the numbers make sense. But what happens after you've got your first property and you're ready to scale? Here's where things get interesting. Most people hit a wall when they try to buy their second property. The bank looks at their debt-to-income ratio and says no. They already have one mortgage. Adding another one makes them look risky. And that's exactly when the strategy I'm about to show you becomes a game changer. It's called the BRRRR method. That's BRRRR by rehab, rent, refinance, repeat. Yes, it's an acronym. And yes, real estate people love acronyms. But this one works. Here's the step-by-step. You buy a distressed property below market value. You fix it up. That's the rehab part. You rent it out at market rate. Then you do a cash out refinance based on the new improved value. And you use that cash to buy your next property. The key is buying below market value, usually at a discount of 20% or more. That equity cushion is what makes the whole thing work. When you refinance at 75% of the new value, you're pulling out most of your original investment. Your money comes back. The property stays. You repeat. A woman named Diana in Atlanta used this method starting in 2021. She found a foreclosure that nobody wanted. 3 bedrooms, 1 bath, needed everything. Picked it up for $85,000. Put $30,000 into repairs over 3 months. Rented it out for $1,500 per month. Refinance based on an as-is value of $190 after repairs. 75% of $190 is $142,000. She pulled out most of her cash. Bought another property 8 months later. Diana now has 6 units. She told me recently that her tenants are essentially funding her portfolio while she still holds the same amount of cash she started with. The BRRRR method isn't sexy. There's no viral moment. It's just math, executed slowly and correctly. But it works because you're not relying on appreciation or a hot market. You're creating value through renovation and leveraging that value to recycle your capital. If you're getting value from this so far, hit that subscribe button. I've got something even better coming up next, the one that most investors never hear about until it's too late. Okay, so house hacking gets you in with low money down and owner-occupied loan benefits. BRRRR gets your capital back. But what if I told you there's a loan program specifically designed for real estate investors that skips conventional lending entirely? No debt-to-income ratio walls. No waiting period after your last property purchase. Just income documentation and the property itself as collateral. These are called DSCR loans. Debt service coverage ratio. The name sounds complicated, but the idea is simple. The bank doesn't care how much you make at your day job. They care whether the property generates enough rent to cover the mortgage. Usually they want the rent to be at least 125% of the payment. That's it. The reason DSCR loans are the best kept secret in real estate investing is that they open the door for people who have W-2 income, self-employment income, investment income. Doesn't matter. The qualification is the property, not you. And once you have a DSCR loan in place, you can scale as fast as you can find deals that make sense. An investor named Carlos in Houston started with conventional financing. By his fourth property, his debt to income ratio was maxed out. Conventional lenders kept saying no. He switched to DSCR loans and bought 3 properties in the next 18 months. Now he has 9 units. His portfolio produces $22,000 a month in gross rent. And here's the part that matters. None of it is tied to his day job income anymore. His tenants are paying for his real estate career. That one shift, moving from income-based lending to asset-based lending, could save you more than the first two methods combined, because suddenly the only limit is how fast you can find properties that cash flow, not how much you make. Not your credit score in isolation, just the math on the deal itself. So there you go. 3 real paths from one property to a portfolio that works for you. House hacking gets you in with low money, down, and owner-occupied loan benefits. BRRRR lets you pull your capital back out and recycle it for the next deal. And DSCR loans remove the income ceiling that stops most investors in their tracks. Pick one. Start there. The investors who build real wealth aren't the ones who found the secret strategy nobody knew about. They're the ones who picked a strategy, executed it, and repeated it until it worked. If this video helped you see a path forward, share it with someone who's been putting off their first investment, and subscribe. I'm breaking down more real estate investing strategies every week, including one that could change how you think about commercial properties entirely. See you in the next one.